Hi there, this is the E.M.I for the month of March 2026. So let's jump right in. In this month's E.M.I, as usual, we ask a few questions. Why is a chokehold around the Strait of Hormuz so important for the energy market? How must one assess the immediate impact for emerging market countries? What could be an India-specific impact from higher energy prices, and how does it look like? Does India have sufficient macro buffers if the uncertainty prolongs? And lastly, will this uncertainty prolong? How must one see India market valuations? Why is a chokehold around the Strait of Hormuz so important for the energy market? The Strait of Hormuz witnessed a sudden rise in military escalations since end February this year, leading to significant disruptions in shipping flows. As we record this, the number of ships through the strait have dropped to almost nil, closing the strait for all practical purposes. Energy markets were quick to respond. Markets were worried about the nature of disruptions and were constantly attempting to estimate how long it would take for a de-escalation to happen and the start of normalization. This is so that they get to assess the impact of this on earnings. The strategic chokehold at the Strait of Hormuz led to a sharp surge in energy prices, fertilizer prices, alongside an appreciable increase in transport costs. Freight rates rose sharply alongside insurance premiums, and food prices are also eventually expected to see upward pressure through these very channels of transmission. Asia appears to be the most dependent on the Middle East for its energy imports, led by South Korea, Thailand, Japan, and India. On fertilizers, however, India appears to be the most dependent, followed by Australia, Thailand, and South Korea. The Strait of Hormuz chokehold. How must one assess the immediate impact for emerging market countries? Elevated crude and natural gas prices seem to seep into higher emerging market inflation. Asian emerging market economies are seen to be the most exposed to an inflationary impact from the ongoing chokehold at the Strait of Hormuz. On an aggregate basis, energy plus food, within the emerging market space, India appears to carry the highest weight in its retail inflation metrics. However, note here that some emerging markets like India have a tight hold on the extent of energy price transmission into their respective inflation variables. A $10 to $20 per barrel rise in crude prices pushes up the wholesale price inflation WPI by around 20 to 50 basis points, and retail inflation, the CPI, by only around 20 to 40 basis points, mainly due to this incomplete pass-through into pump prices. Inflation, however, tends to witness a gradual pickup as the earlier mentioned increase in transportation and freight costs push up broad inflationary expectations. Remember here that in addition to the exposure to crude and food, 70 to 80% of the production cost of nitrogen-based fertilizers like ammonia and urea come from natural gas, exerting pressure on the cost of manufacturing these. One more point to keep in mind is that even after supply chokeholds ease, prices could remain a little elevated for some time due to global geopolitical tensions, shipping or security risks. The near closure of the Strait of Hormuz and other military actions have led to critical shutdowns of the energy sector in the Middle East, and restarting production from these regions could take some time. What could an India-specific impact from higher energy prices look like? India exports just around 15% of its total exports to the Middle East, largely in autos, coal, and jewelry, with the UAE accounting for nearly 50% of this export. A prolonged conflict would eventually have an impact on India's exports to the region, exerting pressure on India's already elevated trade deficit. Higher crude prices push up inflation, 10-year yields, current account deficit, and the rupee. A $10 per barrel rise in the price of crude tends to push up India's current account deficit by 0.3 to 0.5% of GDP. The question on the mind of the markets now is on how long crude prices would remain above $100 a barrel. Why? Because apart from the pressure on India's current account deficit, a sudden disruption or a sudden disruptive spike in crude prices tend to have a negative medium-term impact on India's remittances flow. And therefore, the longer energy prices remain elevated, more frequent would be the need for the RBI to step in and smoothen rupee volatility or rupee pressure. Does India have sufficient macro buffers if the uncertainty prolongs? India certainly has a number of positive macro buffers to resist any deterioration. The first and the most important positive for India at the current juncture, when compared to the Russia-Ukraine crisis, is a much lower retail inflation level experienced currently. CPI inflation currently stands just above 3%, and this is well below the 7.8% inflation peak witnessed during the Russia-Ukraine conflict in 2022. What did the government do then? The government raised pump prices of petrol and diesel around a month after the start of the conflict, and then brought them back to pre-war levels just when crude prices were near their peak. Remember that 5 months into the conflict in 2022, the government had announced a windfall tax of somewhere around 23.5 rupees per ton and imposed a duty on the export of petrol and diesel. These measures helped the government garner around 250 billion. A repeat of these measures appear likely this time around. The ongoing conflict is exerting pressure on the rupee, and India has the macro buffer to manage any untoward moves. India's forex reserves stand at around $725 billion, well above the $525 billion during the Russia-Ukraine crisis. Further, a 214 like NRI bond issuance could also help handle any serious capital account related problems, if they were to occur. Recall that the special swap window introduced by the RBI to attract foreign currency from NRIs to stabilize the rupee mobilized 25 to 30 billion dollars in just over 3 months and greatly helped stabilize the rupee. And lastly, India has plenty of fiscal room to cushion various economic segments if the situation were to prolong for longer than expected. Will this uncertainty prolong? How must one see India market valuations? High crude prices impact markets, but give investors attractive valuations. Crude prices have a near immediate and continued impact on equity market levels, but post certain key thresholds. Crude and Nifty share a sustained inverse relationship only on crossing the $95 per barrel resistance. The current equity market pressure comes after significant pain from FII outflows due to US tariffs and AI. The energy price surge, therefore, has pushed market valuations into very attractive territory for long-term investors. valuing large caps on both 1 year forward PE and earnings yield bond yield gaps reiterate this very attractiveness. 3 months appears to be a realistic timeline within which one can expect the ongoing conflict to resolve itself almost entirely. During this period, the market could present Indian investors with very attractive discounted equity valuations. What can then be a worst case? To put it another way, with the US midterm elections in October November 2026 this year, it seems very unlikely that the conflict prolongs beyond this time frame. And therefore, long-term investors could characterize this as a buy on dips market perhaps.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.